It's been less than a week since Israel started its attacks on Iran.
We've taken out top military commanders, senior nuclear scientists,
and Iran fired back, leading to a death toll on both sides that's climbing. Israel has struck nuclear sites and oil fields, and the aggression has left global markets wary of what's yet to come. Oil prices have already shot up, global markets dipped, as they hold out for the possibility of major supply chain disruptions that could have widespread global impact. To understand the reality of what this war means for the global economy, I'll be speaking to the experts right here on today's episode of Business Extra from Abu Dhabi. And I'm your host, Salim Essaid. Here's our very own Manus Cranny, Geo-Economics editor at The National, who's been tracking the market response to this conflict since day one last week. Manus, welcome to Business Extra.
Salim, good to be with you.
It's been a tumultuous week. It seems like the market has been moving every single day since the war started with Israel and Iran. Can you explain to us what you've observed with your reporting over the past week?
Look, volatility has been the byword, really, in the commodity markets, more so in the oil and gas market relative to the equity markets. Volatility in oil, Salim, is the highest since 2022. And you're seeing some pretty staggering, very initial response mechanisms from the oil market, whether it was the withdrawal of key personnel and family members from some of the embassies through to the actual delivery of missiles from Israel into Iran on Friday that saw the oil market ratchet by 13% at one juncture. That's the most in 3 years, and then fade ever so slightly. But we're seeing these multiple times of extreme ratcheting price higher in the oil market and then a slight fade. So the market is trying to price geopolitical risk and war.
And in layman's terms, what exactly is triggering oil prices to surge and also stocks to drop?
As I say, I think it's a combination of the geopolitical concern, and we have a live hot war. The question is now, where does that escalate to? We have Israel hitting on Iran and vice versa, and the mission is clear according to Benjamin Netanyahu, which is it will continue. He's not done yet. And the question then becomes for markets, having hit, as it were, military infrastructure, nuclear infrastructure, and various sites around Iran, but not piercing the actual enrichment processes. It's just how far will Israel go in terms of its bombardment of Iran? And that is what is causing the spikes in the oil price. We've also seen one of the biggest gas fields in the world, which is shared between Iran and Qatar. It's called South Pars. Now, when I say share, they do not share production in that field, but they have geographic spheres of influence there. And there was a drone attack onshore in Iran, and that sparked a lot of concern around the gas market. The equity markets for now, are not seeing this scale of activity between Iran and Israel as an extreme exogenous shock. The oil market is, however, seeing it as an exogenous shock.
And you mentioned that the geoeconomic aspect is important. Can you explain what it is that we should be keeping our eyes on moving forward?
As you and I are speaking now, we're seeing commentary come from the G7, which is taking place in Canada, in Banff. You're listening to President Macron talk about the need for and the support for a ceasefire. He is the president of France. You have the president of the United States yesterday leaving the G7 meeting with a call for a mediation between Iran and Israel. So the calls for mediation and de-escalation are there, Salim. It now becomes more a question of what are the actions that can be taken by Iran, who we understand are back-channeling through the likes of Saudi and Qatar, etc., that they may be open to discussions. But when and how can those discussions take place? Oman has been the vehicle. However, the question remains, is that the vehicle that we need now, or do we need something much more direct between the USA and Iran?
And Manus, you mentioned the G7 talks and other discussions happening around this. Do you feel that the market is overestimating or underestimating the geopolitical risk here?
Typically, oil markets try to understand geopolitical risk somewhere in the bandwidth of, well, if 1 million barrels of oil disappears from the world's supply, what might that mean to squeeze the market higher? Right now, you're seeing approximately a $10 a barrel squeeze in the price of oil from last week to now. That is the market's typical pricing of geopolitical risk. The real repricing, Salim, comes if there is some kind of constriction in supply through the Strait of Hormuz, which of course is where Saudi, the UAE, and Iraq push a great deal of their oil flow through. If, and it's a big if, that there is a targeting of the Strait of Hormuz and restricting the flow of oil out, then that is a structural repricing and a worst case scenario, which JP Morgan say could take oil to $130. That is not their base case scenario. And that must be clearly emphasized. That's about a 7% probability in their model.
Manus, thank you for joining us.
Thank you, Salim.
Now we're speaking to Colby Connelly. He's a senior fellow at the Middle East Institute, where one of his areas of focus is on oil and gas markets. Great. Colby, thanks for joining us.
Thanks for having me. Great to be here.
We're almost a week into the escalation between Israel and Iran, which is arguably the worst between them. And in those few days, we've seen a pretty steep rise in oil prices. What are the chances of oil prices continuing to rise?
So there's a difference between the type of price spike that's caused by geopolitical risks rising or being very uncertain, which is what you're seeing now. And the difference between that and the type of reaction that you would see if there were an actual disruption to supplies from the Gulf, which at this point hasn't really happened. Right now, the market is searching for any signals it can get on what the direction of this conflict is going to be, and whether or not this direction does pose any actual risk. And you've seen, since the initial sort of geopolitical risk premium got added in to where prices had been, which was basically the low 60s, you have seen some pretty sharp reactions to events that have taken place since. So, for instance, there was kind of a whisper that Iran might be looking for talks aimed at de-escalating, and prices kind of sunk a bit. And then by the end of the day, U.S. President Donald Trump left the G7 meeting early, specifically to handle this situation, and prices reacted in the opposite direction. So, the market likes certainty, and when it can't find it, you see some of these types of shifts until there is more certainty. And that's not to say that more certainty would provide a lower price. It might, if it's pointing towards de-escalation. But if for instance, there is some kind of a major supply disruption, and it's very difficult to predict what it would look like, so I don't want to speculate, then you would see a price reaction to the upside.
Now, speaking on the supply side of things, OPEC last week pushed back on suggestions that it would need to tap into emergency oil stockpiles in response to the escalation, and it said it wasn't currently necessary. What would need to change for emergency stockpiles to become necessary, and would we know that change when we see it?
So when we're talking about OPEC plus supply and how they react to these situations, there are two very important things to consider. The first is that OPEC plus does not like to react to the geopolitical risk premium in prices that I was just mentioning earlier. They react to differences in supply. Their goal, as they will state it, is to provide balance to the market. So, if there's a risk that has pushed prices up, again, there's not an actual supply disruption, and so there's no need to rebalance things. But if there is a supply outage, then they have the ability to tap their spare capacity. And that's the second point that I wanted to come to. It's not so much a case of stockpiles, oil sitting in tanks somewhere, as it is spare capacity, which is why OPEC Plus has the ability to play this role of the market balancer. So, for instance, the UAE is a major OPEC Plus producer. It's pumping somewhere in the range of 3 million barrels per day right now. ADNOC claims that its capacity, I think, is at around 4.85 million barrels a day. I think that's the latest figure that they've given. So they're not producing to the full extent of what they can. And if there is a supply outage from somewhere else in the world, for let's take a step back from the Middle East for a moment and say, for the sake of example, that We lose 1 million barrels a day of Nigerian supply, another OPEC plus producer. Well, then sure, you have the UAE, you have Saudi Arabia, you have other countries that are sitting on that spare capacity because they're producing less than they're able to. And then they can raise production and they can balance the market by adding back some of that supply that is lost. What makes this situation a little different, and it's an extreme case, but it's still a risk that is very real, is the fact that an upwards of 80% of that spare capacity that OPEC plus has, which is right now call it 5 million barrels a day or so, more than 80% of that is in the Gulf. And if you lose in a big way, if you lose supply from the Gulf, you can't replace it with more supply from the Gulf. You can't replace lost supply with more supply from the place where you lost it. And that's what makes conflict like this that does threaten that supply risky to such an extent.
Indeed. Now, you mentioned the impact of Gulf oil on the global economy. So can you speak on what exactly the risk is to the Strait of Hormuz during this war? Iran has said that it would block the Strait of Hormuz if Israel didn't de-escalate. How serious is this?
I think it's a risk that has to be taken very seriously, but it's also very difficult to say what Iran's idea of closing the strait would look like. If Iran were to try to do this in what we might think of as a very conventional way with some kind of naval blockade that stops the flow of marine traffic in the strait, it's almost a certainty that at that point, the U.S. gets directly involved in the conflict, probably other countries as well, and opens things back up again. And that's the type of thing that I think this situation has to deteriorate much more so for Iran to consider. I mean, I'm not going to get too speculative on what the thinking is in Tehran right now, of course, but I mentioned the U.S., but there are a lot of other countries to consider as well. China is very dependent on oil that comes out of the Gulf as well, and it's impossible to think that they wouldn't have something to say to Iran about that. So the question is then, what does in the mind of policymakers in Tehran, what does closing the strait look like? Is it what I just mentioned, which would clearly be a disaster, or is it something more akin to what we saw in 2019 in the run-up to these attacks on Abqaiq in Saudi Arabia? Is it sabotaging tankers? Is it seizure of certain tankers? Maybe types of things that would maybe not be a direct closure of the strait, but that would certainly make a lot of operators think twice about sending vessels in and out of the Gulf. Something that would send the insurance rates for shipping, through the roof, and that would make it very, very difficult to continue to do business as normal, which up until quite recently it basically has been for this kind of maritime traffic. And we could be fast getting to a point where that changes. But because this conflict is so volatile, and I also think because this is something that Iran has threatened for a long time, but essentially never done, it makes it very, very difficult to try and prepare for exactly what that type of a scenario would look like.
Is it because it hurts itself by doing so as well?
Yeah, absolutely. It's really hard to envision a scenario where Iran stops all tankers going in and out of the Gulf except for its own. Especially because then if other powers are going to get involved, and the U.S. comes to mind first, but there's no reason to think that might be the only one. What then happens to those tankers once they leave the Gulf? It's hard to think that no one would be taking action to limit Iranian supply in that scenario. So again, it gets to the point where we have to get a little bit creative in how we think about these events unfolding. But absolutely, there would be a very, very real risk that Iran would be limiting its own revenue. It's essentially only got one customer for its oil at this point, and so that's something they have to consider, especially in times that are as dangerous as these.
Agreed. And Colby, you said that we can't speculate what's going to happen, but it doesn't look good the way things are going. It doesn't seem like either side is standing down. So, with that said, looking forward, which industries do you see being affected by this war if matters continue or escalate?
Yeah, absolutely. I think the risk, of course, to energy shipping is going to remain very real, because of everything we just discussed. I mean, that would seem to be probably one of the first places that you might see this kind of disruption and this kind of risk take place. And although the energy trade per se has not been targeted yet in this conflict, energy assets of various types on different points of the value chain have been targeted in both Iran and Israel. So it's not as though we aren't moving in this direction. And you've already seen, for instance, fertilizer production in Egypt shut down because Israel has shut down its main gas field, the Leviathan field. Iraq, for instance, is very dependent on natural gas imports from Iran. If the South Pars field gets hit again, and Iran ends up with a natural gas supply shortfall, then that could affect some of the neighboring countries that it exports to as well. Of course, the shipping issue extends beyond just energy as well. Of course, the UAE is a massive re-exports hub. And so those kinds of things definitely face risks in a situation like this. It's difficult to, if the situation does continue to deteriorate and spread to different parts of the Gulf beyond Iran, it's very difficult to imagine business as usual for anyone.
And given the race for AI at the moment, how do you see oil prices, these delays, given the escalation that, could happen, impacting, for example, the Gulf AI boom? Will you see oil prices limiting energy supplies that are necessary to power this fast AI development, for example?
I think that might be where a bit of the good news is, because it's hard to see, short of a very, very catastrophic scenario, it's difficult to see the local energy supplies that are required for the AI boom that you mentioned as being too deeply impacted. If there is some kind of worst case scenario where massive amounts of oil production get shut in, and the associated natural gas that comes out of oil wells is suddenly limited in supply, then that's a different situation. But we're a pretty long way from that point now, and the Gulf is attractive as a destination for this AI boom, precisely because it's got these local energy supplies that are very low cost. Their upstream carbon intensity is very low, so there's a much lower emissions impact. And they're not imported from somewhere else, and so that cost factor is pretty well insulated from the type of market volatility that you might see elsewhere in the event of a major disruption. In addition to the fact, of course, that the AI boom is not going to be powered by fossil fuels alone. It's also being powered by renewables, which have extraordinary potential in the Gulf, and the pipeline of renewable energy capacity in Saudi Arabia and the UAE just keeps growing and growing. And of course in the UAE, you've got nuclear powering this as well. So the mix for the energy that's required for AI is pretty well diversified. And conflict raises risks for everything in one way or another, but I think the way that the energy mix has been diversified provides quite a bit of insulation from some of the worst disruptions that you might see if they even occur.
And when you mentioned that how this is going to affect people locally in the region, and I know it's going to be different between, for example, people in the Gulf or, for example, in Iran, where they have electricity issues, and we're actually in part looking at nuclear to help relieve this issue that they're having. What can the average person expect at the pump in everyday goods and services if this continues? Will it be an increase? Will we see higher costs across the board?
Well, if you're talking about life in the Gulf, yeah, it's a distinct possibility, and it part of it will come back to outside of energy, that shipping issue that I mentioned. A lot of economies in the Gulf are quite dependent on different forms of imports. When their availability becomes more limited, that has an inflationary effect. In terms of the availability of energy supplies, again, I mean, there's not much that has happened in the GCC that would affect things locally. Iran, as you very rightly pointed out, is a different scenario. But elsewhere, yeah, you will start to see the price impact for things like here in the U.S. where I am, the summer driving season that's just getting started. People travel more, so when people move around more, there's more energy demand. That's the simplest way to think of it. And this risk premium that has been added to oil prices will certainly push things up a bit. On top of the seasonal demand increase that you expect every year. I think that for now, it's too soon to say that we're looking at a much more permanent increase, because this situation is so volatile that if we hear tomorrow that the parties have agreed to come to the table, as unlikely as that may seem for the moment, let's just say for the sake of argument we do, then as I mentioned in the beginning of our conversation, you'll see a price reaction to the downside. And the market that is normally governed by fundamentals of supply and demand doesn't have to make as many considerations for the geopolitical risk premium anymore. So the risk premium is something that should be viewed as, in theory, potentially more temporary thing. And like we were discussing with OPEC Plus before, that's why they don't like to react to it. If you are an oil or gas company and you're trying to make a longer term plan for instance, how many rigs you're going to operate, you're not going to use what's taking place right now in this price environment as your assumption for the next 24 months, because it could change at any time. You're going to look at the much more fundamental, again, supply and demand picture, independent of these geopolitical events, until they do actually cause a disruption. And then, when that takes place, we can go from there. But the shorter answer to your question is that it does increase costs for the time being. Conflict is always costly. And as I mentioned, markets are things that really like certainty. So the more uncertainty there is, unfortunately, the more of that kind of effect we're going to feel.
Colby, thanks so much for joining us.
Thank you so much. Great speaking with you.
That's all for this week's episode of Business Extra. Make sure to find this and our other podcasts wherever you stream audio, and follow our live coverage on the Iran-Israel war at our site. This episode was produced by Yasmin Al-Taji. Our audio engineer is Arthur Edison. Our editor is Duat Farid. And I've been your host, Salim Essaid.